Great to have you, Deacon.
Nice to see you. It's been a long time.
Yes, it has been too long. As we've said many times, we look forward to having you back at the desk. How does 47 hold, your forecast?
Well, it's a challenge right now. The issue is earnings have been better than expected. Earnings during the first quarter up year over year around 10%, and coming into the quarter, we're looking for something around up 5%. So we've had better earnings, but the financial environment has changed pretty significantly. We've had bond yields go up dramatically, both nominal yields, 1.5% start of the year, now 3%. Real yields negative 1% just 8 weeks ago. Now they're about 25 basis points to the positive. Credit spreads have widened. The dollar strengthened. So all these are part of the tightening financial conditions that was anticipated, just been much more than we had expected. So there's sort of a scenario analysis of a recession, not in our forecast, but that's would put the market like 3,600, and we're much higher, if you will, in a more benign environment. So that's the market seems to be trading those ranges for a long time. Was sort of 42 to 4,600, a little bit below that right now. It's been pretty challenging. Talking to portfolio managers, they've been sort of different minds. Some believe that the economy is going to tip in a recession. Others believe, as the Goldman view, is that the Fed, it's not inevitable that there's a recession, and in fact that the Fed can slowly tighten the conditions, and we can kind of avoid that downturn.
Certainly what William said this morning, that there is a path to a soft landing. We had Jan Hatzius, your colleague, on Jobs Friday last week, and he's holding to his view of peak inflation, but I guess peak means different things to different people.
Right.
It can peak and plateau, or it can peak and back off. How much does that matters to how the market feels?
Well, I think the three numbers to keep in mind are 11, 6, and 5. It's 11 million available positions. There's 6 million workers looking for jobs, and that's a deficit. Therefore, there's more jobs than people, if you will. It's about 5 million. And so the idea, economically speaking, is the tightening financial conditions have to cause companies to pull back on some of those open positions. So that's the economic story. But from an equity market point of view, if you can achieve that, then you have relatively financial conditions will have already tightened sufficiently to let that happen. And the equity market, therefore, would be matching more of the earnings trajectory looking forward into next year. And so that'll be the positive argument, or the kind of central case that we're assuming is that earnings will be driving the market looking forward. And I think then it leads to the idea, Carl, is inside the market, where does one invest? That's really been the discussion point.
So David, it's Morgan. Where does one want to invest? And I guess just in terms of more broadly the market action, what are the signs to watch for in terms of a bottom?
So the couple of key strategies. One is dividends. And so, Morgan, the idea of companies looking at their cash flow and distributing it to shareholders, I think, is a key aspect. If you think about the overall equity market, you have earnings and sentiment and money flow and positioning that would drive the multiple. So there's sort of earnings and multiple. When you're looking at dividends, it's the capacity of a company to actually pay the dividend, cash flow, and the propensity or willingness of management to distribute it in that fashion. So if you look at some of the companies, Amgen, Pepsi, United Parcel Service, those companies have above average dividend yields and dividend growth. Those are also companies that the Goldman Sachs analysts respectively have a buy recommendation on. But the idea, intuition, is that in an environment where there's concern about valuation, dividends that's not a variable in the discussion. It's basically the payment of those cash flows. And if you think about it another way, is that the market trades right now in the swap market as though there is dividend cuts in 2023 and 2024. Our view is you've got 10% dividend growth this year, another 9% growth next year. So first strategy, thinking about dividends. Another would be thinking about the stability of growth. And so we've been discussing just a minute ago, or here with Carl, I know you're on the camera, the other end of it, is the idea of how stable the economic environment will be. And if you're looking at companies where there's a sort of stability in their EBITDA growth looking over the last decade, that's sort of prima facie evidence before the pandemic, during the pandemic, post-pandemic, they've been able to deliver pretty strong growth. Those are some of the attributes we're looking for right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.